Absent a gold revaluation, is there any viable way for China to resolve a $1 trillion a year trade surplus without a disastrous impact on their economy? The math suggests the only other option is collapse. Both China and the U.S. have enormous levels of debt. The U.S. is running almost $2 trillion deficits, all in all in on the fiscal side. And China's running surpluses on the trade side, right? So on the U.S. side, we're still running a deficit, although it's shrinking. That did just shrink. But ultimately, I think gold's going to be the desired rebalancing metric. I think it is de facto, that's what we're starting to see, which is neutral settlement asset at the central bank reserve level. These surpluses are being recycled into gold out of realpolitik necessity. And for China, that improves their balance sheet, improves bank balance sheets, improves consumer balance sheets. And, at some point, the Chinese government's going to have to get people to spend a bit more money than they already are internally.
The global economy is facing a mathematical impasse where massive trade surpluses and soaring deficits can no longer coexist without a systemic reset. Gold is emerging as the only viable mechanism to rebalance these sovereign balance sheets, acting as the ultimate neutral settlement asset. Luke Gromen, a macroeconomic strategist and founder of FFTT LLC, argues that without a gold revaluation, China faces a disastrous economic impact due to its unmanageable trillion-dollar trade surplus. He explains that gold is becoming the de facto solution for recycling these surpluses, allowing central banks to improve their balance sheets without relying on increasingly risky U.S. debt. This strategic pivot to gold not only strengthens China's banking sector, but is also a necessary step to stimulate internal consumer spending and avert a broader economic collapse. Now, we present the clips from Luke Gromen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
We think bonds are going to continue collapsing in gold terms, but I think it's mostly going to happen vis-a-vis higher gold, not lower bond prices. In other words, higher interest rates. I think it's a higher gold price dynamic over rates that kind of don't do much from here, up or down a whole lot further. From GM, absent a gold revaluation, is there any viable way for China to resolve a $1 trillion a year trade surplus without a disastrous impact on their economy? The math suggests the only other option is collapse. I think the U.S. just raised some very important questions around Belt and Road recycling of Chinese surpluses, certainly as it relates to the Western Hemisphere. Basically, if you don't have a military there, you don't control it. And so that then results, in theory, in some other dynamics. Number one, they're probably going to buy more gold and drive gold prices higher. They're probably going to stockpile other raw materials around the world and bring them home, store them in their own borders. I also think you'll probably see them recycle dollar surpluses into more domestic projects, into their own U.S. military, maybe someday into stimulus if they need to. But I think that surplus gives them more optionality than the U.S. on this front. Both China and the U.S. have enormous levels of debt. The U.S. is running almost $2 trillion deficits, all in. All in on the fiscal side. And China's running surpluses on the trade side, right? So on the U.S. side, we're still running a deficit, although it's shrinking. That did just shrink. But ultimately, I think gold's going to be the desired rebalancing metric. I think it is de facto, that's what we're starting to see, which is neutral settlement asset at the central bank reserve level. These surpluses are being recycled into gold out of realpolitik necessity. And for China, that improves their balance sheet, improves bank balance sheets, improves consumer balance sheets. And, at some point, the Chinese government's going to have to get people to spend a bit more money than they already are internally. From SG, just read Hard Bifurcation at Your Request by Craig Tyndale. The parts I understood were eye-opening. Unfortunately, I don't quite speak his version of the English language, so I missed some. If there's some way you could recap, that would be great. Here's the recap. The U.S. has spent the last 40 years pursuing control of U.S. dollar printing and U.S. dollar pipes, monetary pipes, as a source of power. China and Russia realized that push comes to shove, the real value comes not from money printing, the real power comes not from money printing, but the ability to make and produce real things in the real world. push is now coming to shove, which everybody sees, yet everyone's still in denial about the relative importance of the ability to print money relative to make real stuff. So the US is now trying to reverse this mistake, this 40-year mistake, which we're seeing in real time. Every time you see Trump nationalize something, invest in something, what have you, this is a move to try to reverse this mistake. But the paradox is the US needs to move a lot faster, but its debt load is so high that if it moves too fast to do this, it triggers inflation that blows up the bond market, which would then require the US, West more broadly, to do yield curve control, which would crush their currencies relative to China's currency, for example, relative to gold, certainly. And so that's what he's saying is for a long time, the paper world and the physical world were together and they're splitting. That's it. People want to talk about, hey, what's my percentage return? What's Scott Bessent's percentage return on his investment into Argentina? In dollars or in commodities? Because look, the world we're in now, I can't eat percentages. I need food. I can't build a factory with percentage returns on dollar swap line investments into Argentina. I need metal. I need rare earths. I can't refine those rare earths without China. Even if you make 100% on your dollar swap lines in dollar terms, who cares? You need a refinery. That's what that hard bifurcation is saying. From SP, much of your framework is West versus BRICS. How much have recent events, Don Road Doctrine, changed your outlook? And could the USA be squeezing oil sources with moves in Venezuela and possibly Iran? And how much would that influence your outlook? I would say my outlook is my framework is much more based on being the side of the U.S. that got its head kicked in by China over the last 20 years based on the policies of the U.S. government. As I said at a monetary conference in 2021, you all think China can't win. That's your first principle base case. I'm up here to tell you they can win because I watched it happen for 20 years. And you guys are sleeping on them. And they laughed. Guess what? They're not laughing now, are they?
The bond market is silently collapsing in real terms, with gold prices rising to reflect the devaluation of paper currency. This shift highlights a critical, hard bifurcation, where the global economy splits between financial engineering and physical production. For decades, Western economies prioritized control over monetary systems, while Eastern nations consolidated dominance in manufacturing and resources. The analysis suggests that the U.S. is now attempting to reverse this 40-year trend, but massive debt loads make reindustrialization dangerous without triggering severe inflation. Meanwhile, China is recycling its trade surpluses into gold and raw materials, securing independence from the dollar system. In this new reality, strategic power lies not in printing money or financial returns, but in the possession of tangible assets like refineries, energy, and food, proving that physical supply chains now outweigh paper wealth. Let's get back to the interview.
Gold. Gold's going to do great. Gold's going to do great because sustained deflation is going to cause sustained default risk. Governments, banks, municipalities, businesses. Gold is just a 0% yielding bond of infinite duration, finite issuance, and it's nobody else's liability. And so in sustained deflation, everybody else's liabilities trend towards zero, and your gold sits right there. Equities, sustained deflation, they get waylaid, destroyed. Real estate, same thing. Sustained deflation, Great Depression, they get waylaid. But here again, the reason why I think a Fugger portfolio is so valuable for the average investor in the crazy times I think we're going to be in for the next few years is it takes away the two fat tail risks that crush you as an investor. Anything happens in between hyperinflation and sustained deflation, Great Depression, you're going to be fine. You're going to be fine. So that's why I think it's so valuable. Now, do I think we could have deflation? Absolutely, I think we could. I think, quite frankly, we're about to have a period of it because of AI. I think AI is happening way faster than anybody realizes. I think it's starting to show up in the jobs data. When you look at job openings and when you look at unemployment amongst recently graduated college students. The problem in all this is you can't have sustained deflation in a debt-backed currency like we have in a debt-backed currency system. The debt backs a currency. If you have deflation, eventually debt starts defaulting. Debt value starts shrinking. That's the denominator of the currency system. What happens if the currency system, if its denominator starts shrinking because of deflation? You get high inflation, and eventually, if you don't do anything, hyperinflation. Because everyone goes, oh gosh, the debt backing this money is no good. Get me out of my money into anything that is not backed by debt. Gold, silver, precious metals, equities, real estate. So that, in my opinion, when you think about that, gold works either way. And I think that's why gold is outperforming so much right now. Bitcoin, I think eventually, sure, do great. But Bitcoin is still trading like a high beta tech stock. That's just a fact. And if we get some sort of AI-driven deflation, unless Bitcoin starts trading like a reserve asset, then I think, the faster AI goes, the more risk there is that Bitcoin does a COVID March 2020 type of thing. Look, it went from 15,000 to 5,000, 17,000 to 5,000 pretty quickly. It could do that again. That's not my base case, not to 5,000. I'm just saying that type of drop in deflation before the printing starts. The point here is not that I think Bitcoin's going there. The point here is that there's an order of operations that I think is important to mind. In other words, ultimately, yes, I think I have high conviction that there's going to be liquidity added in very large amounts. But getting the path right is important for people, in my opinion, particularly if you're overweight, assets that would be hurt between here and there. Let's see. VN. What would Felix Sommery, who's also known as the Raven of Zurich, say about today's geopolitical financial construct? If you don't know about that, Felix Sommery was a banker, Swiss banker, late 1800s, early 1900s. Through both world wars, he published a book after called The Raven of Zurich, which were basically his memoirs, his notes from the time as we went through it. It's a very expensive hardcover book to get a hold of. You can find the PDF online. If you've not read it, I would get the PDF and I would print it out and I would read it soon. It's like a roadmap for what we're going through. And what do I think he would say? I think he would say, I cannot believe you did not learn anything from the last time all of this happened. Either take steps to devalue the currency, have greater wealth flow to the bottom 50% and to the commodity producing nations, or we are going to get a world war and or a systemic collapse. Buy gold, because your leadership globally does not appear to understand this. Eventually, you'll want to buy some Bitcoin too, but between here and there, there's probably downside first. And then finally from LM, since Japan had a head start in robotics compared to China of about 25 years, would it be safe to assume Japan will help their number one ally, the US, catch up? Love your work. Thanks for all you do. Thank you very much for the kind words. I think it's possible, if not probable, if not likely, Japan will help us. I think we're going to have to, because we just don't have depth of industrial base or knowledge base to do this. With that said, I am and remain fascinated that no one seems to be mentioning what would happen to Japanese inflation if the Americans show up with a several $100 billion order to make robots and weapons and ships and stuff for us. And therefore, what would happen to JGB market yields, which are already they're rising uncomfortably fast, shall we say. And once yields hit a certain point in JGB market, that's either going to create a debt crisis for them, or it's going to force them back into yield curve control to control yields so that they can afford their debt. And then the second thing I'm surprised nobody's asking about yet, and this is why I say invert, always invert, and there's another way. People are not inverting. They're not listening to Charlie Munger. Always invert. Nobody's inverting this. Nobody's asking, do you think the Chinese are watching the JGB market? Do you think they're seeing the yield go and see it as the weak spot? When the Japanese government floats this idea, hey, maybe we want nuclear weapons a few weeks ago. How do you think China reacted to that? Well, let me give you a hint. They came out last week and said, we're putting in export controls on dual-use goods that could be used by the Japanese military. Some sources say that could be up to 40% of the goods that China exports to Japan. Who is Japan's number one import supplier? By far, China. Now, what happens if Chinese goods get cut off enough that inflation really starts to pick up, and then the Americans show up with a several $100 billion order for goods? Inflation takes off. What happens to the JGB market if inflation takes off? What happens? The yields go up a bunch fast. Then you run a correlation of JGBs against U.S. Treasuries or UK gilts or German bunts, whatever. It's all the same chart. It's all the same chart, just on various slight timing differences. So invert. Weak spot's the bond market. You think the Chinese don't know that? You don't think they're already acting? Come on. You got to invert. If I could leave you with one thing, in 2026, it is already to me crystal clear that it is absolutely critically important to invert everything. Look at the other side of the ledger. Look at the dog that didn't bark. Everything, what everybody tells you. Otherwise, I think we're going to get whipsawed a lot if you're not doing that.
Gold remains the ultimate hedge in a debt-based monetary system because, unlike equities or real estate, it carries no counterparty risk. In a scenario of sustained deflation, potentially accelerated by rapid AI advancements, liabilities trend towards zero through default, while gold acts as a zero-yield bond of infinite duration that preserves value. Historical warnings from figures like Felix Sommery, the Raven of Zurich, remind us that ignoring wealth disparities and currency valuation inevitably leads to systemic collapse or conflict. Furthermore, applying the inversion principle reveals critical vulnerabilities in the global bond market, particularly in Japan. If geopolitical tensions constrict supply chains between China and Japan, while the US demands higher industrial output, rising inflation could push Japanese government bond JGB yields higher. This would likely trigger a global sovereign debt crisis, making gold essential protection against both deflationary shocks and the eventual inflationary response. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.